Let's get more reaction in bond markets to the bank's cuts that we've seen, of course, in reaction to the RBA decision earlier in the week. Stephen Nash joins us from FIIG Securities. Firstly, I guess, Stephen, perhaps some reaction from you on the NAB dropping those deposit rates, 50 basis points yesterday. We've seen the CBA come out and do a bigger than expected, or bigger than the ANZ cut yesterday on the variable home loan rates.
Yeah, look, the banks, as you know, have had that increased funding cost. I think the estimate roughly is around 25 basis points. We've seen an increase from some of the banks earlier in the year of about 6 to 7 points, and also a saving, it looks like this time, of about 15 to 18 points. So it looks like the banks have recovered most of that increase in funding costs now. So going forward, the banks, in terms of matching RBA, should be a little bit closer than they have been in the past. Funding costs recently have improved quite a bit, but still elevated relative to 2011. So I suppose going forward, one can expect the banks to follow the RBA a little bit more closely than they have been.
Okay, what about some of the rates that are on offer for investors out there at the moment then?
Look, at the moment, corporate bonds yielding almost double what the government bond is yielding. Government bonds are very low at the moment, around the 3% level. A 3-year bond, for example, you can get basically double that by looking at corporate bonds. And I think the bond market's telling investors that growth is going to be quite low. Inflation's obviously going to be low, but I think the main point is growth will be low, which means equity markets will be quite volatile going forward. So the idea of fixed income isn't out of the picture. Obviously, rates are low in the government sector, but corporate bond yields are still quite elevated.
And I guess we get a little bit more info on all of this with the Statement of Monetary Policy on Friday, because the RBA sees, well, I guess, lower growth, doesn't it? Certainly growth has not been as good as it had expected. Do you think it will actually back up that 50 basis point cut earlier in the week?
Look, I think that typically the Statement of Monetary Policy, which follows an action by the RBA, basically justifies the move. So I imagine that the data or the story will be fairly subdued growth going forward, possibly mentioning expectations of continued weak credit growth, uptick in unemployment, non-mining sector broadly doing a little bit worse, and that sub-trend growth being mentioned quite a few times. So I imagine the statement will be quite subdued in nature, and obviously they'll be also mentioning the prospect of this fiscal tightening we've got next week.
ECB, of course, in the meantime will meet tonight, so that monetary policy statement comes tomorrow. Tonight we have the ECB. Is it likely to adjust policy? What are we expecting in terms of commentary about further stimulus? You know, given the figures that we've seen overnight, manufacturing deteriorating, unemployment rates all over the place rising.
Well, the question is, who doesn't expect a recession in the pan-European situation? I don't think anyone does. So the ECB is facing mounting pressure at the moment regarding its policy. I imagine the market doesn't expect that they'll move, but there must be increasing pressure every day on them to do something further to stimulate growth. There isn't much that they can do at this stage. However, I think the pressure is mounting every day on them to ease a little bit more.
Stephen, thank you so much. We will chat soon.
Thanks very much.